One of the major challenges in crypto, and specifically with smart contracts, is having verifiable data to make sure that the smart contracts work correctly, and that comes through oracles. Mike Cahill from Pyth is leading the charge here for first-party verified data through their oracle, which would allow smart contracts to do basically everything that trusted third-party humans do. We talked about why data and oracles are so important in the crypto space.
Let's go.
So tell me, what is Pyth?
So Pyth is a data oracle that is combining together data from first-party sources, so trading firms and exchanges, and aggregating them together on-chain in a way that's fully transparent, where any person can look at the provenance of the aggregation, and then it's distributed to all the blockchains from there. So got its start on Solana. And the idea for using Solana as the layer one was to pick the chain with the fastest block time, the cheapest gas, and then you can be at the fastest block time for anyone slower. So it's a pretty easy decision. We're now a year into being live, and we've covered pretty much every application that needs a oracle on Solana, and we're going cross-chain.
So your biggest competitors, Link, is that basically what we're talking about here?
Yeah. So it's a different twist to how they source and distribute data. And so the biggest differentiation is that in the Chainlink model, they typically will get data from third-party sources. And so what it means to be a node in that model is you are going out and fetching the data, and then you're publishing it. And so nodes there are usually run by DevOps teams. In the Pyth model, it's quite different. And so the nodes are the data providers themselves. There's no kind of extra step to carry that data on chain. And so these data providers are publishing. And what's unique and cool about it is that the population of data providers today on Pyth, there's over 65 of them, consist of the largest trading firms and exchanges in the world. And that has been, I think, the thing that has gotten people excited about Pyth. There's trading firms that historically have always just fought to the death in trading. And they've come together to try and build this and to try and solve this oracle problem in a different way. And what I think they see the view of this is, if you can solve this oracle problem by using data that comes directly from us and we've got ownership to it, this is going to be a scalable solution.
What's better than listening to the Wolf of Wall Street's podcast? Listening and watching the Wolf of Wall Street's podcast live. Well, they say what happens in Vegas stays in Vegas, but this time that's not the case, because I'm hosting a stage at a conference from October 10th to 13th. That's the WebEx conference. I'm going to be bringing you live podcasts, live panels, master classes from the leading minds in the industry. This is going to be absolutely epic. It's going to be live streamed, recorded, and presented to you live. You can come have a happy hour with me, eat dinner, potentially play golf, and watch all of your favorite content being recorded in real time. Guys, the link for this is web3expo.live. That's web3expo.live. Use code WOLF20 to get 20% off your ticket. WOLF20 for 20% off your ticket. Guys, let's hang out in Vegas, October 10th through 13th. Can you talk about, there are probably people who are watching who literally are like, what is an oracle?
Yeah.
Can you talk about what an oracle is and why it's so important?
Of course. Yeah, so an oracle and the oracle problem for crypto, moreover, is the way that you get data into a system that can be used on a smart contract that can be fully trusted, right? And so the classic example is we have a smart contract, and we said we're going to bet on the price of Ethereum, and let's pretend it's like 2,000. And so I say it's going to be above 2,000 in a week, and you say it's going to be below. Very quickly from the simplistic example, you can understand that if I'm the person providing that reference price to the smart contract, I'm going to be biased to say that it's above 2,000, and likewise, if you do it, you're going to be biased to say it's below. And so that simplistic example, you can extrapolate, and you can understand that this smart contract is going to do whatever is programmed to it. There's no person that's going to have a sanity check. And you see this all the time. There's, trades that will happen, and flash loans can take advantage of of the protocols, because there's no person that's checking. And that's what we like about crypto, right? We like the fact that there are no middlemen and there's no gatekeepers, but it becomes so much more paramount that that data is accurate. Now, in the Web 2 model, like, data is pretty prevalent for most stuff, right? So for crypto data, you can get it on CoinMarketCap and CoinGecko. But if one of those websites goes down, it's like a mild inconvenience for you. You're like, oh shit, I'll go check another website. But if you're a smart contract and you're relying on data that's coming from here and it goes down, that smart contract's going to do something, right? It may say that you've been liquidated out of your position. So that's where, that really underscores sort of the problem.
Yeah, someone gave me a great example earlier where it was like, Chiefs play the Rams. One of you bets on one of you bets on the other. We know who won, but does the smart contract know who won? Right. So is there a risk to that third-party model? Because then you still have to be able to verify that the data is correct?
That's right, yeah. So the risk on the third-party model is really twofold. So the first one is that you don't have any skin in the game from the place that you're getting the data from, right? Like CoinGecko doesn't know that it's securing smart contracts. So that's like the first problem. And then the second problem is when you expand beyond the scope of crypto markets, because crypto markets for market data is generally free. Most of the exchanges give it away. But that doesn't actually work for all asset classes. In fact, for the US equity market, like, it's a multi-billion-dollar a year business selling market data from the large trading firms. And so when you think about getting that data on chain, it's unlikely that you're going to be able to do this for free. Like, you couldn't go to Yahoo Finance and take the price of Apple and bring it on chain. You're going to get sued very, very quickly.
Right.
So the idea with having first-party data providers that own this data is you don't have this risk of having somebody's data that doesn't belong to you being distributed and eventually being shut off. And also the data providers, in a very similar to a proof of stake model, will stake on behalf of the integrity of their data. And so then they're incentivized to continue to make the system more robust and more accurate, both by positive rewards and then being slashed.
Which aligns with the very ethos of crypto in general.
Yeah.
Right? Incentive, what's better for the whole is better for the individual as well.
That's right, yeah. If you can get the incentives and you can have positive incentives, you can develop a very positive outcome.
Are there issues when the data is false? Because obviously, I mean, even anecdotally, CoinMarketCap, CoinGecko, I love them both, but there's times you go on there and the price of something is wrong.
Yeah, exactly.
Especially if it's one of the more nascent or smaller assets.
For sure. This is one of the reasons why you use an Oracle network. And so the way that Pyth approaches this is that there's, as I said, 65 data sources. There's been one added every week this year, if you count up the number that have been added. And the more that you have, the higher the resilience is, right? And so if one is bad, well, then you've got 64 more. And so that number that you have to move the aggregate ends up becoming quite high. And you have to have this coordination from people who are really not looking to try and move this.
It's like the 50%, 51%.
It's like a 51% attack. So that's one component of it. And the other component of it is Pyth has an output that consists of a price as well as a confidence band. And that's super important because, as you know, the price of Bitcoin is going to vary from one exchange to the next. And it's going to get more pronounced, that dispersion of pricing, when there's high volatility. And so, like, when there's the depegging for UST, Luna price was just going down, very crazy. There were exchanges like Wobi, for instance, had blocked their deposits. And so they were trading at like a 600 times premium versus, say, KuCoin. Now, both of those two exchanges are data providers for Pyth. And so the price for Pyth for Luna continued to update. And you'd see that the price was very accurate on where the trades were happening because the trading firms, so Jumps and Jane Street, Alameda, et cetera, they're all contributing to prices of where trades are happening. But then the confidence band actually says, well, there's a wide disagreement about where prices could be printed right now. And so it's going to say it could be somewhere in this huge band, right? And so if you're a smart contract, you can use that information and you could say, we're going to limit the amount of, let's say, transactions that can happen during this period of high uncertainty. We're not going to halt you from doing anything, but we may limit the amount of stuff that we want to have happen. And so it's a better solution than the previous solutions, which is like slow things down, right? Normally, the
circuit breaker.
Yeah,
exactly. Seen in the stock market, of course.
Like this time, stop. But people, so there's a great article. Sam Seezy's son was like, "Hey, you want to use an Oracle?" And went through all of the different attacks, right, and how they break down. And his conclusion was, it's probably best to use like an average over a long period of time. And that's okay. It's a good Band-Aid, but it's still wrong, right? Like the price when it's slow and it's coming up with an average is wrong for the next tick. And it could be meaningfully wrong if you're using it over a long period. So these confidence bands are really novel in that they give you the accurate information with the entire span of what could happen and allows the protocol developers to program into the app what they want to have happen.
I mean, you talk about the jumps. I believe you worked before.
Yeah.
Right?
Yeah.
Alameda, Jane Street, high frequency traders.
Yeah.
They need their data to be accurate to the millisecond.
Absolutely.
You're not talking about an average over, literally to the millisecond, and their edge that they spend millions, tens of millions of dollars on is being milliseconds faster than somebody else.
That's right. And that's what really resonated with this group. It's if you're going to solve the Oracle problem, you need to do it with the fastest speed, and it needs to be equitable for everyone. So if you were to choose a slower layer 1, for instance, to compose on, then the Solana price is going to be delayed. And actually, you're never going to be able to be accurate for that chain. And that's why it was very quickly, we came to the conclusion that the Solana blockchain was, going to be the right one for us to develop this on. And then using Wormhole, we go to other chains and kind of generic message passing.
I love Solana. What happens when they're down?
It's a good question. So Solana obviously has been very successful and things that they probably had never anticipated. So, they were set up to showcase really some of the stuff in DeFi. And then NFTs happen, and there's times when people are minting, hundreds of thousands, millions of NFTs, and the block space gets super clogged. So in order to go cross-chain, Pyth has created a separate instance of Solana using the Solana technology. It's called PythNet. And so that's what feeds all the other chains. So in the Solana ecosystem, Pyth still compiles there, and you can get data there for first-class treatment for any of the apps that are building on Solana. But for all the other chains, it's coming from PythNet. And the thing for people on Solana is when Solana goes down, it goes down for both the Oracle and the app. So we're all in the same kind of boat. But on the other chains, it's resilient to that.
Is that something you built as a reaction to what had happened, or something that you built in advance as a just in case?
Yeah, that's a good question. I'd say that we always had anticipation that we would want to have some resiliency. And what pushed it forward was we were getting very close to going live cross-chain, and people kept asking these types of questions. So we needed to demonstrate that there was something already built.
Okay, so talk about how you operate cross-chain.
So cross-chain is this PythNet, which is this private instance of Solana, is secured by the data providers as validators. They send the message out over Wormhole, and Wormhole is a generic message passing protocol. And then anyone who's using a target chain, so we've just deployed on BNB, and we've got contracts available on all of the EVM chains. So a protocol on BNB, so Venus is the launch partner, will look at the Wormhole price that's updating every 400 milliseconds. And any one of those prices is eligible to be pushed on chain. So if you're a liquidator, for instance, and you're running the role of trying to earn the liquidation rewards on Venus, you could be watching that price on Wormhole as it updates, and you say, okay, this meets the criteria. I can bundle this together with the liquidation transaction, push that over to BNB chain in a single transaction, and it's done.
It's pretty incredible.
Yeah.
Can that scale to infinite chains, or is there a point at which it doesn't particularly work?
We think it scales to infinite chains. So earlier in this week at Masari, Aptos announced how Wormhole and Pyth, moreover, are going to be deployed there. And so on the Move contracts, or the Move language chains, Pyth will be there. Really, as long as Wormhole continues to connect other chains, then we can do this and scale with them. We really kind of compose on top of that.
So you talked about having basically 60 some odd sources for the information and data. Is there a point where it becomes too many? Is there a point where you mentioned that it could be too few? Is there an ideal sort of target for how many you would want?
Yeah, I don't think that there's an upper bounds, but for now, the protocol has selected and only allowed in data providers that have got really strong reputations. And so there's all these household names that are in there. What we'd like to evolve to over time, and this has been outlined in the white paper, is a model that's completely permissionless. And The way that you do that is you include a stake, and anyone can come. You stake what you want, and then you have an accuracy check, and then you get rewarded for highly accurate data. And if it's inaccurate data, you get slashed. So I think that will incentivize like a lot more people to come in. We'd expect that the data probably, or the rewards probably consolidate to a handful of larger players, like I'd say 50 or so. I do think there are probably diminishing returns. But when you think about scaling to other asset classes, so today Pyth is about 75% crypto, and then probably 20%.
That's my next question.
Yeah.
Here, go.
Sorry. So
No,
20%
perfect.
equities, and then FX and metals. The usage is all, the demand on crypto today in Web3 is all crypto. The equities is more of a showcase, like, hey, this is a great way that you can get equity data on chain. There's not tons of building that's going on. People are using it in off-chain things. They're like, wow, actually, this is a free place to get an Apple price that updates every 400 milliseconds, and I don't have to pay anything for it. And it's right on the website, and I can write an API for it. So we are seeing that. It's a kind of unintended but positive, side effect of it. But as we start to continue to scale that, we're going to be in the thousands of symbols for next year. Then you'll have specific data providers that will focus on, areas that they specialize in. Could be Asian equities or maybe rates and bonds or options.
Sounds like the death of Bloomberg.
I wouldn't think so. I think that what it is it's really like a, very specialized solution for blockchains. Bloomberg is, unless they get into the Oracle space, like, it has its niche.
Right, but if you're providing the data that people are paying for just as quickly in real time.
Yeah, it could be. It could be a competitor. Although Bloomberg's catalog is super comprehensive. And so I think the switching costs for that for someone to actually move over, like is relatively high. You'd have to very comprehensive. And look, the opportunity to be the world's best Oracle and be this infrastructure rails that applications build on is big enough. So we're not trying to beat Bloomberg at the moment.
Everyone got that, right? So don't come after them, Bloomberg. So what are the, I guess, the biggest potential in your mind use cases for what you guys are building beyond? I mean, I think we'd all agree this is very early.
It's very
early. So
like
when we're not very early anymore, what will Pyth be doing? What will people be using it for?
Yeah, so today Pyth is focused on DeFi, and there's like two primary use cases. One is lending protocols, and the other ones are on the trading side. And within trading, we see basically three types of applications in like a broad sense. So the first one, and I'll go from like the lowest dependency to kind of the highest dependency. So the first one ends up being a settlement price. And so this works on kind of exchanges or that do futures or options, decentralized option vaults as well. And so the Pyth price kind of is, that view. The second one is for like funding. So if you're doing perpetuals, like using the Pyth price as every hour, we're going to try and bring this perpetuals market in line.
As the market price.
As the market price, exactly. And then the third one which is really cool, is we're seeing AMMs that use it as the midpoint price. So instead of having like arbitrageurs bring it in line and having impermanent loss hurting the LPs, you actually just follow the Pyth price and say, okay, we're going to have this curve for liquidity and allow people to transact there. So I think that's like a good model. It's cool, right?
Yeah.
I think that's a really good model of how things will continue to evolve. But what I think will happen is we'll start to see new assets get added. It won't just be crypto. And the tying together of these markets, the reason I described it in kind of that detail is that's how they'll be tied together, right? So you can have a divergent set of exchanges, both in crypto and non-crypto, as long as you have a canonical reference price that everyone agrees on, and it's got the, kind of these positive feedback loops of more data providers coming in there and reinforcing the fact that it's a reference. That will tie those together, and you can actually do this in multiple places, and you can grow a really divergent and exciting set of exchanges.
It's really cool. And one of the most exciting things, I think, for traders and people who came into crypto, certainly in 15, 16, 17, was the ability to arbitrage these huge gaps and the massive inefficiencies in the market. Yeah. It sounds like you guys are actually eliminating that and making the market far more efficient.
Yeah, it could be. What we're trying to do is make the market more trusted so that you can bring in new participants. And that's been the ethos of why these firms who fight to the death, Drain Street and HRT and DRW and jump trading and so on, that's why they're all doing this. It's like, I want to go build the arena where I'm going to go fight you to the death. But for now, we're going to have to work together to build it. And we want to have first-class tooling so that when, you get more and more people, right now we've got such a small number of users, like probably 50 million, monthly active wallets in DeFi. When you eventually have that grow, you need to have like first-class places to engage.
So when you talk about new participants, are you talking about new funds, or are you talking about retail literally taking that from 50 million wallets to 500 million wallets to 1 billion wallets?
Yeah, I think it's both, but the thing that excites me more is the billion wallets.
Yeah. Do you think we get there?
I think we'll get there, yeah. I don't know when it'll happen, but yeah, I think it's inevitable.
Do you think that, well, I know the answer now. I don't think we have any blockchains that can operate at that scale.
That's right.
Now. So do you think that the technology will be able to scale to the level where we can accommodate 1 billion people actively using DeFi or transacting on a day-to-day basis?
Yeah, I think that as long as you have people, as long as you have an incentive for people to build better technology, then it will happen. Solana has made the bet that, as long as hardware continues to get cheaper, then you can continue to make the network faster. And others have used sharding, and those are different bets as well. I think if you had a huge flood, like here's a good example. For Solana, when they started getting like spammed from all this activity on NFTs, it wasn't unusual for you to see like, 2,000 transactions per second. And then they would go down and, they'd come back like an hour later, or could be even 24 hours later in some cases. And then, you'd have Tolly would write something like, we've made it better. And you could actually look at the Solana Block Explorer, actually their transaction per second keeps going up.
Right.
So they do get better each time. And I think that if you inspire someone with tons of activity, then, they'll find answers for it or another solution.
It's the 0 to 1 and then 1 to, right. I had Anatoly recently on the podcast, and he basically made the contention, which is actually like, we were never down. It's like we were just slow.
Oh yeah, that's true actually. Technically it's true, I suppose.
So it's not like but I think that it's an important differentiation for them. And his argument was that he believed that if necessary, Solana could operate at that scale and be the singular blockchain-based layer.
Could be, yeah.
Which is crazy to imagine when you obviously see NFT projects freezing these blockchains. So in a perfect world, does Pyth just continue focusing exactly on what you're doing now? Or are there other things in the roadmap that you guys are looking to build?
Yeah, so we do think about being really good at providing market data on chain. We know that there's a lot of other use cases for data on chain, and we'll look to expand to those types of things in the future in a similar capacity. Find novel sources of data that's clearly theirs, and allow that to be published on chain. I think that there's a lot of experimental stuff. There's the idea that a farmer in Bolivia can buy like weather options to hedge the poor crops or something. And I think that we're a little bit far away from those use cases being kind of materialized. But if he starts to catch wind, like if, say, people really wanted sports scores on chain for some reason, I could see that being an area where Pyth would expand to more quickly.
I want to see that.
Yeah.
Right. I mean, sports betting is a huge market, and there's a lot of places that do that with crypto.
Yeah.
So it seems like a natural fit for something like that. Listen, I think over the last, we could say years, but certainly in the bear market and since DeFi summer, there's been some egg on the face of DeFi. I mean, you talk about wormhole, right? And anyone I think who hears the name wormhole just thinks of a hack.
Right.
Right. Do you think that there's been sort of a diminished excitement about DeFi in general, or do you think that that's just sort of more of a mainstream narrative?
Yeah, I think that what we don't see letting up at all is the number of people that are continuing to build or moving from Web 2 to Web 3. And so I think that's like the benchmark or like the KPI that we kind of focus on a little bit more. The excitement from your average person is going to come with the price of the token.
Yeah.
But the actual building and like the kind of the long-term metrics, I think are the ones that we kind of care about the most. I think DeFi on the interoperability and like the bridging side of things, it's still very early, and there's it's very competitive. I think every bridge has had some kind of a hack at some point, but we're starting to see that mature. And just like when you had exchanges, remember like the narrative in 2015, 16, 17 is that you never wanted to keep too much money out
Because
of
the
brokerage.
exchange would be hacked.
Because the exchange would be hacked.
Yeah.
But now exchanges get hacked and you don't lose your money, right? Because they figured out, we can get an insurance policy, or we'll be less, we'll be smarter about the management of our wallets. We have a cold wallet over here, we have a hot wallet here. And so that actually doesn't really happen all that often. So I think that because it's just sort of unfolding, we're in this kind of a lot of things break, but over the next couple of years, that'll all get much more mature.
Yeah, that makes sense. I think the unfortunate part is just the asset class is under more of a microscope or a spotlight now. So it's now being written about in the New York Times instead of in some nascent crypto publication. Do you view DeFi in the future as a parallel rail to the existing systems, or do you believe that it can actually become the rail for finance?
I think that there'll be certain aspects of it that it's going to be better at than the kind of the traditional finance, and there'll be some things that traditional finance is better at. So one thing that comes to mind is, interoperability is a big thing that's going on. The other thing that's really interesting is in zero knowledge, right? So it doesn't make tons of sense. You would take your Venmo and you don't want everyone to see what you've done with it. And that's effectively what we have with blockchains, right? Yeah. So that needs to be resolved.
You mean they're not good for criminals who want to hide their transactions?
It's not just criminals. It's
I know,
exactly.
Basic privacies, of course. Right.
So I think until that gets solved, then I think CeFi is actually probably better for me and my spending and stuff. And then over time, maybe you'll have better solutions, but we haven't yet seen all of those having been built yet.
Right. Yeah. But privacy is a huge issue, obviously, in the blockchain space. We've had some really compelling conversations around that, but that's not obviously what you guys are specifically focused on. So do you believe that you could then become the data provider for all of these legacy?
That's our mission and our goal. And what we're hoping to do over the next year is to be the largest Oracle as we deploy on chain, to have the same impact that we've had on Solana and all these other chains, and provide the kind of the security, the added security for any application that needs to use data.
Well, I hope nobody ever needs a Bloomberg terminal again, and that you guys completely replace that. Man. Thank you so much
for the
conversation.
That's dope.